What's up YouTube? I'm William Bitter and this is my channel Money Thoughts. Today we're going to talk about capital gains tax, specifically pertaining to investing in stocks. Full disclosure, I'm not a professional accountant of any sorts. I'm just a guy on YouTube sharing my thoughts. When it comes to taxes, everyone's different and each case requires special attention. So I was just thinking what video could I do that would have a long-term impact on people. A lot of people already know about the compounding returns of stock investing, but the less sexy topic is taxes. But the way that we understand capital gains tax can actually have a huge impact in our overall returns in the stock market. You can make just over $40,000 and pay 0% taxes on those gains, which is incredible, but most people are making at least $40,000 of income, and so that means that their capital gains will sit on top of that income and put them between this bracket of $40,000 and $445,000. So most people are paying 15% on their capital gains. So to keep things simple in this video, I'm just going to assume that we are single. And as you can see, once your capital gains go above $445,000, the capital gains tax rate goes up to 20%. So all these numbers are actually pertaining to long-term capital gains. Long-term capital gains means that you must hold on to that stock for at least a year, at least 12 months, in order for it to be considered a long-term capital gain. If you buy and sell a stock within less than 12 months, that is considered a short-term capital gain, and it is taxed at your highest marginal income tax bracket. If your marginal income tax is 35 or 40%, then that capital gain, if it's not held for, then that investment, if it's not held for at least a year, will be taxed at 35 or 40%. As you can see, there's a huge benefit to holding on to an investment for more than 12 months and paying long-term capital gains tax versus short-term capital gains tax. So I actually made this nice little spreadsheet to help people play with some numbers. I'm going to leave a link to the spreadsheet in the description below. So definitely check out the spreadsheet, download it yourself. You could follow along with me if you want, or play with it after you watch this video. So we're going to compare 4 different strategies and see how they perform over the course of 50 years. So in the spreadsheet, you can actually edit each one of these 4 categories, and you'll get a bunch of numbers that will spit out from this. So for this example, let's just say that we start investing at age, so I'm 31, so we'll just use me as an example. So let's just say I start investing at the age of 31. Marginal tax rate is basically, if you just Google your income tax, just Google income tax calculator by state or city and then plug in your income, and you can see your marginal income tax. So that's the highest bracket of taxes that you pay, which is what your short-term capital gains will be taxed at. So mine, I want to say is 40%. I guess for simplicity's sake, let's just say at 31 I invest $100,000, and let's just assume that I'm going to get a 10% annual ROI on that $100,000. All right, so first, I know a lot of people have started investing over, ever since COVID, and a lot of people started staying home. There's a lot more young people that have been investing, and a lot of people are buying and selling different stocks within the same year. And so when you do that, when you're only holding on to your investment for less than 12 months, right, you are paying short-term capital gains tax, or around 40%. Maybe I'll make this 35% just because not everyone's paying a 40% marginal tax rate. So let's just say 35%. And you can check all my formulas and all my work. This is kind of all the numbers behind the outputs over here, but these are the outputs. All right, so that's short-term capital gains, right? So the next strategy would be a long-term capital gains tax, where we sell our investment every 12 months. That means, every year we see a different investment that's we think is a little bit better than our current investment, but we wait exactly 12 months to make sure that when we sell one investment, we're paying long-term capital gains tax of 15, usually 15, sometimes 20%. And then we're immediately buying into another stock, which we hold for exactly 12 months over and over again for 50 years. So that is this second strategy of long-term capital gains tax paid every year. So our third strategy will be long-term capital gains tax paid all the way at the end. So basically, you don't realize any gains until you actually sell the stock. So this strategy would be holding on for the very long term. That means that like the number here will mean that like at year 15 you will sell the stock and pay the capital gains tax one time on all your gains. And then all the way off to the right here I have, I guess this could be the first or fourth strategy, whereas basically this is a way where you can completely avoid capital gains tax. And if you guys don't know about this already, like definitely look into opening a Roth IRA. Roth IRA, you can put, most people, depends on your income, but most people can put about $6,000 into your Roth IRA every year, and that's the limit. But the great thing about that $6,000 is it grows tax-free, and you can actually make trades. If you have a self-directed Roth IRA, you can make trades, and as long as you don't take it out of that account until you're like, I think 60 years old, you don't have to pay taxes on any of the capital gains. So I would highly recommend maxing out that account. If you plan on living past 60, definitely max out your Roth IRA, $6,000 a year if you can afford to do so. And obviously this is the highest returning strategy because you literally pay no taxes on your gains at all, ever. So these are the numbers. So let's look at the visuals that I've created. All right. So first I showed the 10-year comparison because it's kind of hard to see the 10-year comparison here. But as you can see, in our 10-year comparison, the number one strategy for $100,000 invested, the 10% annual ROI, is the Roth IRA, where you paid no taxes, and that Roth IRA should be worth about $259,000 at the end of the 10 years. Obviously, you're gonna have to wait till you're 60 to spend it, but as you can see, just within 10 years, you have a much better return. And then the next best strategy here is long-term capital gains at the end at $235,000, and this is obviously because the next best strategy here is $226,000, so not that big of a difference, but there is a difference. And I guess what the difference is here your long-term capital gains paid annually, you're missing out a little bit on the gains that you would have made if you didn't pay taxes on those gains throughout those 10 years. So like each time you pay the 15% tax, you're missing out on the gains that extra 15% would have made. And so you can see there's a little difference, 226, 235,000. So $10,000 difference after 10 years. And then obviously the short-term capital gains tax, where you're paying like 35% tax, this is more than double the long-term capital gains tax. You're going to end up with only $187,000 at the end of 10 years, which really sucks, compared to 226. I mean, this is like the difference between night and day, right? So this is the 10-year comparison, but what's really crazy is because these things move exponentially, these habits compound over a long period of time to make a really big difference, and you see that over here in the 50-year comparison. As you can see, the difference between these strategies really starts to fan out as you go further out into time. And this is what I really wanted to show you guys, because as you can see, that $100,000 investment after 50 years If you were to only have short-term capital gains, you would have, that $100,000 might be a little over $2 million, 2.3 million bucks, which sounds great. But then you realize that if you were to just hold on to each one of those investments over the course of 12 months at least, and sell every 12 months, you'd actually end up with a return after 50 years of 5.8 million. That's more than double the return just based off of a different strategy around taxes, right? Which is pretty mind-boggling. But then if you were to just hold on to an investment and it had the same return, but you waited 50 years to sell it and you paid taxes after those 50 years, instead of $5.8 million after 50 years, after taxes, you would have 9.4 million. That's almost double of the other strategy. So this really, to me, this really drives home the need to find, to really think about what you're investing in and really like try to find things that you're willing to invest in for 10, 20, 30 years, if you can 50 years. Personally, I think Tesla is that stock for me. All of their addressable markets, energy, artificial intelligence, the labor force with humanoid robots, full self-driving. Anyway, that's a whole nother rant. But just really think about what you're investing in and try to invest in things that you would be happy to hold on to for a long time. Because if you think about it, just the difference between switching your investments every 12 months and holding on to something for 50 years is almost double your return, right? And then obviously your Roth IRA is number one strategy. So this is why you should max out your Roth, because as you can see, $100,000 in a Roth versus $100,000 in a regular investment account. It's 9.4 million versus 11.7 million, which is a big difference. I mean, the difference between short-term capital gains of 2.3 million and putting money into a Roth of 11.7 is staggering. So I hope this spreadsheet helps you guys think about your tax strategy. And I put this spreadsheet together. I'm pretty sure it should be accurate, but if anyone sees any mistakes, I'm human, so let me know. I did have the capital gains tax rate switch from 15% to 20% once the capital gains went above 440,000, went over 400, whatever that threshold is that makes the capital gains tax go up. As you can see, I have a conditional statement here where, if capital gains tax is above 445,850, then do 15% tax rate, otherwise do a 20% tax rate. So I built that in, and I'm going to leave a link to this spreadsheet so everyone can try to make use of this. Put in a different age, put in your personal marginal tax rate, and your starting amount, as well as what you think your annual ROI for your stocks are going to be. Obviously, this doesn't account for inflation and all sorts of little things, but hopefully this gives you a good place to start thinking about these things. I really think that these kinds of tools are powerful, and I hope they help someone out there make some good financial decisions. Obviously, double check all this, do your own research, talk to your accountant, etc., etc. But if you appreciate me taking the time to put these things together, I would super appreciate that you like this video. Please comment below and let me know, did you already know about this, or is this new or fascinating? Is this helpful? Until next time, guys, peace.
Save and invest your money.